All right. Looks like we got some people jumping in here. We're just gonna give it another 1 or 2 minutes here just to let everybody get in and get settled with their audio. And then we'll get started here. While you're jumping in and while we're waiting for everybody to join, why don't folks go ahead and share, maybe their name, their company, and their industry in the chat. We'd love to know where you guys are coming from and see if we can make some connections across some of these industries. Got a lot of good conversation we're going to have here today, so excited for this one. We'll get started in just another maybe 30 seconds or so. And throughout the conversation, feel free to ask questions in the chat as well. We'll make sure to hit those either during the conversation or afterwards. Would love to kind of hear what you guys are curious to learn more about. Very excited to have John here today to talk to us about some of this stuff. So we'll give it 15 more seconds. I see most people filing in here. Again, uh, you know, I encourage everybody to drop your name, company, industry in the chat. I think it'll help everybody sort of think about how we tailor this a little bit more to what you guys are interested in. So, and any questions, again, feel free to jump in the chat. With that, why don't we get started? I think we got a quorum of people here. I'm really excited to welcome all you guys to this webinar on growing and preparing your service business for a successful exit soon or one day in the future. By way of introduction, I'm Toby, and I'm the VP of Growth here at Coast. And I'm really excited that we've got John Bartlett here joining us for this webinar in our second of a series, trying to sort of bring more educational content about sort of businesses like yours to customers and folks in the businesses that we serve. John is the founder of Brentwood Growth. He's got more than 3 decades of executive leadership and business transformation, helping business owners to achieve their growth objectives. He served as the president and COO of Capital Systems for more than 15 years. And under his leadership, that company grew from 10 million to 100 million in ARR in annual revenue. John was later the managing director for a couple of different prominent financial services firms. And now he leverages his network of private equity firms, industry consolidators, strategic buyers, and other owners and operators to help create the right outcomes for business owners who are considering selling their businesses in the near term or scaling for a potential future sale. And so really excited to have John here to talk to you guys a little bit more today. For those who don't know, Coast is a company focused on helping businesses with fleets of vehicles to better manage their expenses through a card and expense management platform that we've built for growing businesses in the trades and construction and transportation. Really focused on doing the hard work for folks who need to manage a lot of expenses out in the field, like fuel or other expenses, so that you guys can actually focus on running your businesses and doing some of the stuff that John will talk about here today, without worrying as much about whether or not all your money is getting spent in the right place. But we're not here to talk about Coast. And so, I'll turn it over to John here to really dive into the meat and potatoes for today. Really talking about, your businesses and how you prepare those for an exit going forward. So John, I'll hand it over to you.
Thanks so much, Toby. I've got a presentation here to pull up. Let me get it up here. Cool. Is it up there? Yeah, I'll go right here. Is that okay right there?
I think we may just want to switch it.
Slideshow. How about that? Is that better?
Perfect.
Cool, cool. Well, thank you so much. I'm John Bartlett. I started Brentwood Growth 6 or 7 years ago, and we are merger and acquisition consulting advisors, and we work with service providers and contractors in the trades. Anyone that's residential, industrial, commercial focused. And that includes roughly 25 different sectors, things like HVAC, plumbing, electrical, roofing, garage door, lawn care, landscaping, mosquito and pest, pools, foundation, cleaning, janitorial, really anything inside or outside a home, an industrial or a commercial building. Um, our clients fall into one of two categories. They're either thinking about selling the business in the near term, and they want to know what the value of the business is, who potential buyers would be, what a potential transaction structure would look like, and what a timeline would be, both to get the business sold and for them to transition out. Or they fall into a second category where they still might want to sell the business at a certain point. They want to scale and grow the business. Maybe they want it to be a self-managing business where they can take more of a passive role and the business sort of runs itself. But regardless of what their longer term outcomes are, they still want to know what the value of the business today is and the kind of things that they need to focus on to increase the value of the business, to increase the marketability of the business, so that when it comes time to achieve that outcome, whatever that might be, they can have the best outcome possible. So we have an advisory part of our business for clients that are wanting to sell, and then we have a consulting part of our business for clients that are wanting to scale and grow for a future sale. And, one of the things that I always say is um, life is like a jigsaw puzzle with a bunch of moving pieces on the table. We've got the financial side of our life, which is all about numbers. What's my business worth if I sold it for that number today after I pay taxes, after I pay fees? What would the net be that I was able to invest when I combine that with other assets that I've saved? How does that fit into my larger financial plan? And so there's the financial side of our life, but then there's the life side of our life. And the life side of our life sometimes gets more complicated. Do I still enjoy the business? Do I still look forward to coming to work every day? Do I still have gas in the tank? Or are there other priorities in life? Are there other things that I would rather be focused on? Are there other priorities that I need to sort of rearrange? And look, I'm not I'm not a life coach and I'm not a marital counselor and I can't help you with any of those sort of big life decisions. I'm not a financial planner. We're not wealth planners. We can't help you, fill all the pieces of your financial equation together. What we can do is we can tell you what your business is worth today. If you want to sell the business, we can help you get the business sold. If you're trying to grow and scale the business, we can help you figure what that's going to look like, and we can help you do that if that makes sense. And the point is, when you get clarity on the life side and when all of that comes into focus, we want to be sure that the financial side of your life fits together the way it should. And if it makes sense to sell your business at that point in time, we want to be sure that all those financial pieces fit together at that point. So it's a little bit like Liam Neeson in the movie Taken. We've got a very specific skill set and we can't do everything, but we can tell you what your business is worth. We can tell you what your business could be worth, and we can help you get it sold potentially. Um, I want to talk a little bit about what's going on in the market today. And I'm sure you guys go to trade shows and you go to conferences and you talk to colleagues and you're hearing all this conversation about all this private equity money that's out there that's chasing service providers and contractors in the trades. And your question is, A, is it true? And B, what's driving private equity interest? And C, who are all these private equity firms and what does a potential transaction with a private equity firm look like? And I, I, I want to provide a little bit of color and clarity around that. The first thing I can tell you is yes, it's true. There is a tremendous amount of interest through private equity firms, through independent sponsors, through family offices, through independent investors. Certainly, institutional money is very, very interested today in looking at service providers and contractors in the trades where there are various investment theses and reason that's driving this interest. If I had to sort of summarize it, some of the characteristics that private equity looks for is they look for large fragmented industries that have multiple owners that are going through some sort of generational transition. And part of what their strategy by and large is they want to choose a particular sector. They want to find interesting companies that sort of meet the theses that they've been able to develop. And they want to buy multiple companies that have similar characteristics that are in perhaps different parts of the country, and then they're doing what's called roll-up consolidations. And by that, I mean they're forming a holding company, and through that holding company, they're buying maybe 10 to 30 different companies, might be HVAC companies, might be plumbing companies, might be roofing companies, might be irrigation companies, might be foundation repair companies. They're taking particular segments, they're developing expertise in that particular sector, and then they're buying multiple companies within these sectors. These companies are going to continue to own and operate within their own brand. They're going to maybe consolidate some of the back office operational areas that the companies have to get some economic efficiencies. They're going to maybe move some of the reporting systems over to a central reporting system. They're going to get these companies operating somewhat similarly in their respective markets. And by consolidating these companies, by buying these companies and by consolidating these companies through a holding company, they're going to help these companies grow over a 3 to 5 to 7 year period. And then they're going to take that holding company that now consists of maybe 15 to 20 other companies, and the value of that holding company, as you combine all of these companies, the value of the holding company is worth much more than each of the individual companies would be. And so they're going to consolidate these companies over a period of time. They're going to get some organic growth, and then because each of these individual companies are now owned by this holding company, when they go to sell the holding company potentially 3 years, 5 years, 7 years, your company that they bought for maybe 5 million or 10 million, whatever the number is, because it's now owned through this holding company, the multiple expands that the holding company is going to trade for. And that means that they might have paid $5 million for your business because it's owned by this holding company now. They can sell the holding company, and your individual business has maybe doubled or tripled in valuation size because it's owned now by this holding company. And I'll explain that a little bit further, and that's part of what we call multiple expansion that I'll get to in a moment. And so, yes, it's true. And many of these private equity firms, they'll develop specific sectors that they're very interested in. One of the reasons that the trades have become so attractive to these sectors, and COVID had something to do with it. You know, we came through COVID and everything got locked down, and we began to hear about essential services And a lot of the trade sectors, because they were essential to, residential homes or industrial or commercial buildings, they were considered to be essential businesses that stayed open through COVID. Many of these businesses performed very well during COVID, actually saw growth during the COVID period. And so all of a sudden, through COVID, essential businesses became of interest. Private equity firms, they looked at the fragmentation of these sectors, they looked at the size of the sectors, they looked at the lack of cyclicality that occurred, the fact that these sectors they perform well during economic booms and maybe economic slowdowns, and all of that was of interest to them, and so they began buying HVAC companies. And then when they began buying HVAC companies, they started buying plumbing companies. And then when they bought plumbing companies, they began to buy electrical companies. And so what's gradually happened over the last particularly 3 to 5 years is a lot of these private equity firms have looked across the blue collar trades and have seen similar characteristics that exist in each of these sectors. And so their platforms and their acquisition strategies that are really growing day by day as new private equity firms are coming in the market and they're seeing the value that can be created by buying blue collar trade companies. And so, I mean, I can tell you just our company alone, we probably get requests from 3 to 6 additional firms that want to be added to our distribution list that want to look at deals that we're bringing to the market. And so the market continues to grow of potential buyers that are looking to buy companies in these sectors. One of the things that it's important to understand is, I mean, whether it's private equity firms or whether it's a strategic buyer, whomever the buyer might be, I think it's always very important for owners to understand when it comes time to value your business, how do you determine what the business is worth? And so let's start there. And so at the end of the day, any business, and when I say any business, I mean I don't care if we're talking about Amazon or we're talking about Apple or we're talking about Google or we're talking about my business or we're talking about your business. The value of the business is a multiple of the business's free cash flow, a multiple of the business's free cash flow. Now, let's define those terms. Okay, first, what is free cash flow? Well, forget what your tax return shows. We all do the same thing from a tax standpoint. We try to get the business to pay for as many expenses as we can to help us from a cash standpoint, cash flow standpoint, to help us from a tax standpoint. And so as you're filing your tax return and you're reporting to the IRS, this is the net income of the business. Well, that doesn't always tell the full story because there are lots of expenses that are loaded in there that doesn't really show what the true free cash flow of the business is. And so you got to sort of take the tax return and park it aside. And let's go to the financial statements. Many of these companies, many of your companies are using QuickBooks or something like QuickBooks. And so when we get into the QuickBook files and we look at what the profit and loss statements are in the QuickBook files, we're getting closer. You sort of look at that net income line that's there in whatever financial reporting system that you're using. That net income number is going to be closer to telling us what the actual free cash flow of the business is. Now, the thing that the net income on your P&L has sort of embedded in there is it has additional expenses that are included in your profit and loss statement that need to be added back to the free cash flow. It's things like owner's compensation. I mean, whether it's the salary that the owner or owners are taking out of the business, whether it's distributions that are taken out of the business, We want to determine what the owner's compensation is on a cash basis that's coming out of the business, and we want to add that back to the net income. And so the first thing that we do is we begin building a list of add backs. Okay, this is what the P&L shows from a net income standpoint. Let's add back all of the owner's compensation. And so that's going to take that net income number and that's going to make it a higher number. The next thing that we want to look at is we want to look at other benefits that the owner is having the business paid for. We want to look at health insurance. We want to look at retirement plans. We want to look at personal expenses that the owner might be running through the business that they're getting the business to pay for. We want to take those expenses and we want to add those back again. The next thing we want to look at is are there family members that are in the business that we're paying as part of the payroll and maybe we're doing it to help family members out. Maybe we've got certain family members that are involved in a piece of the business, but we're really overpaying them for what their market value is in terms of the job that they're really performing. And so we want to add those family members that are maybe not critical to the business or family members that we're overcompensating. We want to sort of normalize that income further. And so that's another add back. The final add back is there can be non-reoccurring charges. You might have rebuilt your website this past year and that cost you $20,000. There might have been a lawsuit and you had to pay an attorney $10,000. You might have bought a bunch of trucks and equipment because that needed to be restocked and you spent $100,000 here. We want to look at whatever non-reoccurring charges that the business paid for in the previous year, and we want to sort of normalize what those expenses are. The number that we're trying to get to is if a buyer bought this business today and we made all those adjustments and we identified all of those add backs and we adjusted what that net income was, what's the actual free cash flow of the business that an owner could expect to receive over the next 12 months? And so that's the first half of the equation is we want to identify what the free cash flow of the business is. The second half of the equation is owners are going to take that free cash flow and owners are going to determine what multiple that they're willing to pay for the business. And the multiple could vary. It could be 2 times that cash flow. It could be 4 times that cash flow. It could be 8. It could be 10. It could be 12. And owners, as they're buying the business's ability to produce cash flow, and owners are measuring the risk of that cash flow on a go-forward basis by the multiple that they're willing to pay. Smaller businesses that have fewer employees, that have fewer clients, that are very owner dependent in the owner operation of the business, they're going to pay a lower multiple for those businesses because in their mind, if the owner were to leave, there's more risk that cash flow could be impacted if the owner left. So there's more risk in that business. They're going to pay a lower multiple for that. Larger businesses with more employees, with more infrastructure, that have departments, that they have management teams, that is less dependent upon the owner from a day-to-day operational standpoint. They're going to view those businesses from a cash flow perspective as having less risk, and they're going to pay a higher multiple for those businesses. And so owners measure their risk of that cash flow being impacted if they were to buy the business by the multiple that they're willing to pay. And this is the way we think of businesses as sort of falling into different categories based upon the size of the business, based upon the revenue of the business, based upon the number of employees, based upon the owner dependency And from these categories, the multiple that the business is going to trade for is going to vary because businesses that fall into these seven categories have different characteristics. So this is the way that we think about it, and we call it seven levels of growth. A level one business is a business that's doing less than 500,000 of revenue. It's got maybe the owner and a couple of employees. The cash flow is going to be somewhere, if it's a 20% net margin business and it's doing 500,000, the cash flow is going to be around $100,000. The multiple that level one business is going to trade for is somewhere between 2 and 3 times cash flow. That means the value of that business is somewhere between 2 and 300,000. That's a level one business under 500,000. A level two business, the way we think about it, it's a business that's somewhere from a revenue standpoint between 500,000 and 1 million. Let's assume that the net margins again are around 20%. That means that business is producing around 200,000 of cash flow. The multiple, because it's a slightly larger business, the multiple that the business is going to trade for in the market or the way buyers are going to view it, there's a little bit less risk in that business. Therefore, they're going to pay a slightly higher multiple for that business. The multiple range of a level two business that's doing around $1 million of sales, it's the owner and maybe 3 or 4 employees. It's a little bit bigger now. It's going to be between 3 and 4 times. And so when you do the math, you've got 200,000 of cash flow. You've got a multiple of 3 to 4 times. The value of that business is somewhere between 600 and 800,000. It's beginning to grow. It's beginning to grow because you've got a higher cash flow number and you have a higher multiple. Okay, level three business. Level three business is doing somewhere under 2.5 million. 2.5 million, let's think about it. You've got maybe 8 to 10 employees. You've got a sales team that's beginning to form. You've got a marketing department that's beginning to form. You've got several people, a couple of people in the client services role. You've got some ops people. You've got a bookkeeper there. You've got maybe 4 or 5 techs out in the field. It's a business that's beginning to take shape now. And so let's say it's doing 2.5 million. Let's say let's say it's still a 20% margin business. The cash flow is going to be somewhere between 5 and 600,000. The multiple is going to expand again. It's going to get bigger again. Instead of that business trading for 3 to 4 times, it's going to trade for 4 to 5 times. And so now we're talking about a business that's getting somewhere in the 2.5 to 3 million range. And so you can see here that the value of the business through a combination of a higher cash flow and a higher multiple, the value of the business actually is beginning to get above what the revenue of the business is. It's really getting interesting at that point. Level four business, doing 7.5 million. Do the same 20% margin. The cash flow is going to be around 1.5 million. Look what happens again. The multiple begins to expand again. It goes from 4 to 5 times to 5 to 6 times. All of a sudden, we have a business now that's worth somewhere in the $8 to $10 million range. It's a much bigger business. You got 7.5 million of revenue. You might have 20 employees at this point. I mean, you got a real business now. You've got a business, you've got real departments, you've got managers in those departments. The owner, instead of the owner being involved in everything, the owner's still very involved. But the owner has managers that are managing these departments. And, the expression, the owner's working on the business now instead of in the business. The dependency that the business has on the owner now is beginning to go down even further because you've got more of a department now. You've got individual departments and you've got a real business that's being formed. And so it's got some girth to it. It's got some scale to it. The owner can go on vacation. He can be gone for, she can be gone for 2 weeks. She can turn her phone off. He can turn her phone off. Doesn't have to worry about the business. The business is able to perform. You got a real business now, and you've got a business that's attractive to potential buyers. And you can continue to follow the sequence here as the business gets larger, the cash flow gets larger, the multiple gets larger, the valuation gets bigger. And so this whole multiple expansion through a higher cash flow, it gets larger and larger and larger as these businesses get bigger and bigger and bigger. Now, if you take this concept and you apply it to what private equity firms are doing, remember what they're doing. They're buying maybe 20 different companies 20 different companies that are each individually producing $1 million of cash flow. Maybe they paid 5 to 6 times that cash flow when they bought the business. And maybe there was some organic growth that they were helping these companies achieve through their holding period. But think about the business at a holding company level. You've got a holding company that now owns 20 businesses. The cash flow of the holding company is now, let's do the math, $20 million. You've got a business that's producing $20 million of cash flow. What is that business going to be valued at? Well, that business might be valued at 15 times cash flow. So your business that they paid 4 to 5 times because it's owned by a holding company now, when they go to sell the holding company, the value of your business just by being held by this holding company, it's doubled in value through this multiple expansion. And this is how private equity folks are able to achieve so much wealth that they're able to create for their investors because they're able to take advantage of the aggregation that takes place and the multiple that expansion that takes place through this roll-up consolidation strategy. Toby, does that make sense to you?
Yeah, it makes perfect sense to me. I think actually one of the things that would be interesting here, and maybe we can just looking at the time here, start to get some questions from the chat as well. Is thinking about like um, some of the strategies that you've seen work well for folks to either help increase free cash flow or increase, sort of that multiple. Maybe we can stick with one or the other, but I'd be curious to see, you've seen a ton of these businesses. Where have you seen people actually make some meaningful progress on helping to get a better valuation than they would have today after working with you guys?
I think it's two things. I think you've got to grow the revenue. And as you grow the revenue, obviously, if you're taking a business from $1 million to $5 million, you've got 4 employees, and maybe at 5 million, you've got 20 employees. And so as you're growing the revenue, you've got to be sure that the infrastructure to support that revenue growth is keeping up with the growth of the business. And, I mean, we can talk about labor shortages and the challenges of getting technicians and all that stuff. And I understand that's real, but the first thing you've got to do, you've got to focus on growing the revenue. The second thing, I mean, growing revenue in itself doesn't solve the problem. You've got to laser focus on what the profitability of this business is. You got to look at your cost of goods. You've got to look at your gross margin. You've got to look at your operating expenses. You got to look at what the net profit is. And so I would say, most of if it's a service-based business, their gross margins should be in the 40%, 45% range-ish. And so any incremental bump that they can get in terms of improving what those gross margins are is going to drop to the bottom line. If it's a contracting businesses are probably not going to achieve margins in the 40 to 45% range. It's probably in the 30 to 35% range. But anything that can be done to help manage expenses properly to increase what the gross margins are, any point or two that they can pick up in terms of their expense management, all of those points of expense savings is going to drop to the bottom line, and that's going to impact what the cash flow is. And as it impacts what the cash flow is, that's going to impact what the multiple is. As it impacts what the multiple is, that's going to impact what the valuation of the business is. And so you working with guys like you and being able to pick up, a couple of points of expense savings, whatever it is, any expense savings that can be achieved, or in improving what the gross margins are and what the net profit margin is, that's going to increase the cash flow, that's going to increase the valuation, and that's going to increase uh, the multiple that the business is going to trade for. So grow the business, keep the infrastructure there to allow the business to support that growth, and laser focus on the P&L, your operating expenses, your gross margin, your net margin, and any point or two or three that you can pick up in cost savings is going to drop to the bottom line, and that's going to dramatically increase what the valuation of the business is.
That makes perfect sense. And I think, kind of inherent in all the stuff you're talking about here is like step one is actually like knowing what these metrics are for your business and having clear line of sight into all those expenses, into where your revenues are coming from, so you can think about how you start to expand. Which obviously there's a whole set of topics we can get into from that perspective as well. But I think before you can start to optimize around some of these things, you gotta measure them right in the first place, which is hard while you're trying to manage the actual business, right? And focus your resources on growing it itself.
Yeah,
Uh,
and it's hard. It's hard. Running a business, yeah, it can be the most rewarding thing in life, and it also can be the most challenging thing in life. And, you're in the trenches and bullets are flying, and you're trying to keep customers happy, you're trying to keep employees happy, you're trying to keep the wheel turning. You're hoping that something falls out of the bottom that you can make a little money, you can pay your bills. And so it's so hard, it's so hard to find the bandwidth and to be able to focus strategically on the business because you're so deep in the weeds and just sort of keeping the machine turning. And, you know, we, gosh, we probably have 300 owners a month that reach out to us that want to have a conversation about the business. And so, we get a lot of data points from a lot of these conversations. And you know, in the beginning, when you're a level one or level two business, you're just, do I have something here? Can I make this thing work? Can I pay my bills? Can I make payroll? Is there any profit that's left over? And so you're just struggling to try to keep the thing up and going. And, if you're a 35-year-old, you think about the business differently than a 65-year-old thinks about the business. If you're a 35-year-old, it's screw it. The value of the business, that's tomorrow's problem. I don't give two craps about that right now. I just want to keep the wheel turning. I want to keep everybody happy. I want to, make a little money. But, the hardest thing for us, and we have these conversations all the time, when we'll have a 65-year-old guy call us and he says, well, I'm ready to retire, I'm tired, I'm beat up, mama wants to move to Florida, we want to play with the grandkids, all of this stuff, I need to sell this business. And we'll get the financials in and we'll do the valuation, and we'll say, well, your business is worth, $800,000, let's say. And he said, $800,000, I need $3 million to sell the business in order to retire. And it's just sad, and it breaks my heart there that I wish that we had had that conversation with that guy 10 years prior to him getting ready to sell it, because the value's not there, and I'm not sure they're buyers for that business because it doesn't have the scale that buyers are looking for in order to buy a business like this. And so, you know, when should you be having this conversation? Well, I mean, I don't think it's ever too early. I think, you know, you always should know what the value of your business is. You should at least get a valuation done on an annual basis so you've got an idea. You should put some projections together as to, okay, if I grow the business at 20% a year and I get these margin improvements, what could my cash flow be in 5 years? What multiple would the business trade for? What's the value of the business at that point? You, you, you always should have a snapshot of what the business is worth today, and you should always have a game plan on a rolling 3 year period or 5 year period or 10 year period what the objective is that you're building towards. You can change this all the time. You can, you know, at the end of 10 years, you can say, well, heck, I'm 55 years old. I want to keep going. Well, you don't have to sell it just because you had that conversation 10 years prior, but you should always know, okay, this is the value of my business today. This is what it could be worth a year from now, 3 years from now, 5 years from now. And you should always have that roadmap in place to know what you're building towards. You should always be projecting out, and you should always be sort of goal oriented so that you've you've got a plan. The plan can change, but you're intentional about what you're doing.
No, I think that's great advice, John. To your point, it's never too early to start making plans. You know, things will pop up, but at least you got something to follow there. Um, before we I think John, correct me if I'm wrong, we just went through most of these.
We did. And there are all sorts of other nuances in terms of, you know, what you want the revenue mix to look like and how you know, don't get overly dependent upon any one customer or any one employee. The kind of things you can be doing, you know, the number of Google reviews and the way your website looks and the way your lead flow is, what your revenue mix is, how much of it's new construction oriented, how much of it's retrofit or replacement oriented, how much of it's service and maintenance oriented. I mean, all those things matter, but they're sort of secondary and tertiary considerations to that cash flow number. It's gonna impact where in that multiple range you're gonna fall. Are you gonna fall at the top end of that range or the bottom end of that range? But those are secondary, really, considerations as to where the value of the business is. I think at a high level, we've covered the major points.
Gotcha. Um, well, look, I certainly learned a ton. Again, I would love to, if there's any questions in the chat, you know, anybody who has any questions they wanted to share with us, please do pop in here. While those questions come in, I'll just give three quick plugs. One, sort of on the back of what we were just talking about, in terms of it never being too early to have the conversation. If anybody on the call does want to have a conversation about, you know, preparing for an exit, John, clearly your expert here, will share his contact info and Brentwood Growth's contact info out after the call, so anybody can reach out there. Or for those of you who you know, want to and or if you want to talk to Coast about, you know, how we can help sort of with managing those expenses and getting that visibility into those expenses a little bit better. Whether you work with Coast already or don't, you know, you never know where we might be able to help you find something to do with your fuel expenses or with your field expenses, or, you know, how money is moving through your business. So don't hesitate to reach out there. And then we'll also share a survey. We'd love to see what other topics people want to learn about. You know, we're in this you know, sort of journey with you guys. One of the things actually John mentioned is something we talked about in our last webinar around thinking about sort of those personal financial goals, and how those ladder into when you make this decision, and also how much you actually, want to be aiming for, right? You're the only ones who can decide what that goal is. John and his team can help make sure you guys, are reaching that and that you have those conversations in the right time. But setting that goal is important too. And so we have that content too if folks want to listen on that. But if there's other stuff you guys want to learn about, definitely let us know. We got a couple questions in the chat, and I know we're over time, John, but hopefully you can stay on for a little bit longer just to
Man,
answer two or three of these, if you don't mind.
sure.
Great. Uh, so uh, I'll start at the top here. Kevin Kingsbury from Anacapa Heating and Air was asking a little bit more about sort of like tax implications, and basically like how to think about like both I think valuation and like actual cash like after tax, or the numbers you're talking about pre post tax, like where do taxes fit into sort of like how to think about the valuation of the business and what your end take home might be.
Yeah, great question. So I think let me quickly talk about deal structure. So buyers, when they buy the business, they're buying the business on a debt-free, cash-free basis. And so any debt that's on the business, there might be an SBA loan, there might be an EIDL loan, there might be some truck payments or something that are still on there on there. They're buying the business on a debt-free basis, and so they want all of those debts paid off with the closing proceeds. Okay, so you need to think about that. Now, the flip side of it is they're also buying it on a cash-free basis. They want a little bit of working capital left in the business so that they can make payroll, but any excess cash and receivables on top of that, you get to keep with you, take with you on top of the sale on top of the sale proceeds. So they're buying the business on a debt-free, cash-free basis, and so that's a good thing. Now, in terms of tax, and this is really important. The numbers that I have talked about are the valuation of the business on a pre-tax basis. And so you've got to figure the tax implication after you receive those proceeds. And so I'm not an accountant. The tax advice that you're about to get is worth exactly what you're paying for it. But I can tell you that the vast majority of the proceeds are going to be taxed at long-term capital gains. And so, depending upon what your income is, it's probably in the 15 to 20% range. There might be some additional state taxes depending upon where you live and how your state wants capital gains to be paid. And so I would sort of figure that after you pay your taxes, between Washington and the state, I mean, they're going to take around 25%. If you use someone like us, um, we're going to market your business and we're going to get your business sold, and you're going to pay us a success fee that's going to come out of the sale proceeds. And so if you use an advisor or if you use a broker to sell your business. They're on top of the taxes, you need to take other fees into account that need to come out of the sale proceeds. There are going to be some small additional costs. There's going to be a purchase agreement that's going to be drafted. There might be an employment agreement. You're going to need to hire some outside counsel to review that, and that might cost you another 5 to 10 thousand.
Gotcha. And yeah, I mean, I think
You need to think about everything. You need to look at the headline number, but back out all the fees and expenses and taxes from that also. Around 30%, I would say. 35%, somewhere in that range, is the amount that's going to come out, and you're going to keep around 2/3 of that after taxes.
Um, very helpful, John. And I think, to your point, definitely want to make sure you get your tax advisor involved, but always good to have a sense of the numbers there. Um, uh, a couple other questions actually that came in on a slightly different topic. Really thinking about like what's the right level to start the conversation? One person specifically asked, Scott asked, that they get emails from buyers looking for sort of companies, and they always reference EBITDA above 5 million. Is that a pretty hard and fast rule where, you kind of need to at least have that amount, or is there a certain amount that's too small for you to start these conversations? How do you think about that? I know we're talking mostly about free cash
Yeah.
flow, which ties.
Yeah, no, yeah, yeah. And investment banks and private equity firms like to use fancy terms, EBITDA and sellers discretionary earnings and all of that. And they're right from a technical standpoint. But at the end of the day, I like to talk in free cash flow terms because we're going to end up at the same place. We just have a different way of getting there. And so when they're talking about EBITDA and I'm talking about free cash flow, there might be some minor adjustments in there, but we're basically talking about the same number. Okay. So let's talk about different buyer groups. And we've talked exclusively about private equity firms. And so, but when we go to market a business, we think about three different buyer groups. We've got private equity firms that are doing this roll-up consolidation sort of strategy, and that's one buyer group. The second buyer group is you might be an HVAC business in Atlanta, and you might be too small for a private equity firm, but there might be other HVAC and plumbing businesses in Atlanta that are looking to grow. They might be a competitor of yours right now. You might be a nice complement of what they're looking for. And so that's a strategic buyers that are already in the space that do not have private equity money behind them. That's a second group of buyer. The third group of buyer is you've got smaller owner operators, guys that are maybe in the trades and working for somebody else, and they want to own their own business. One of the things that has become very popular today. You've got search funders that are, corporate executives that are tired of the W-2 rat race and sort of want to own their own business. And so these are corporate guys that are gals that are looking for businesses to buy. And so you've got this whole sort of third wave that's out there also. So you've got private equity firms, you've got strategic buyers, and you've got owner operators. I would say for private equity firms, and again, it's going to depend upon what sectors we're talking about and what area of the country that we're in and what the revenue mix looks like. I would say that the free cash flow EBITDA number probably needs to be over $1 million for even the second and third tier smaller private equity firms to be interested in those types of businesses. If you're a smaller company, doing 500 to $1 million of cash flow, that's not to say that they're not buyers out there, but you might be too small for a private equity firm, but there might be a strategic buyer or an owner operator market that would buy your type of business. And so it's going to change a little bit based upon the sector, what the revenue mix looks like, and the part of the country. But I do think anything north of $1 million, you're going to of cash flow. You're going to get private equity firms interested in you. And those guys that are saying $5 million, I mean, they're larger private equity firms, and that's what they're looking for. But there are 10,000 private equity firms out there. Just because that guy, you're too small for that guy, that doesn't mean you're too small for somebody else.
I think that's it's a really good place, I think, to wrap the discussion. I think there's, to your point, probably a buying group that's interested at all sizes. It's about finding sort of that right group for where your business is at. There are more questions in the chat, but unfortunately, I think we're coming up on time here. With that said, if we maybe flip to the next slide, like I mentioned. John and his team are available for conversation, and we'll make sure that anybody who had a question in the chat that we follow back up with you guys directly to make sure you get those questions answered. But the best place to get those questions answered is to start with a conversation with John and his team. So wanted to shout out that once again. Separately, if anybody wants to have a conversation with Coast on the expense management side, if we go to the next sort of page, don't hesitate to reach out to us. And we'll send out a little survey at the end. Again, we'd love to hear what other topics you guys are interested in learning about. Um,
Any penny of cost savings matters. Anything matters. Go grab that stuff, man.
It's great to hear. And John, lastly, thank you so much for the time. I think everybody learned a lot, looking at the questions. I certainly learned a lot, and really appreciate you sharing your expertise with us here today. So,
Happy to do it. We're here if we can help anybody. Happy to have a conversation.
all right. Y'all have a great rest of your week.
Thanks,
Thanks.
dude.